different taxing schemes can be integrated into a single framework. When we do this, when we have a blended tax environment, one of the first things you need to do is consider the portion of investment return from interest versus dividend versus capital gain. Let us say that in our simple world, these are the three kinds of returns that we are getting. The convention used in the curriculum is that the portion of income, investment income coming from interest, is denoted by PI. This is denoted by PD and P capital gain. So the P is simply for the proportion of income, and the I subscript is for where is it coming from. Example 6 I'll do real fast, where you have a portfolio of 100,000, it grows to this amount. What's the overall return? 8%. If the interest is 400, what is PI? It is simply 400 over 8,000, which is 0.05. What about dividend? So PD is going to be 0.25, and the P capital gain is 0.45. Should this add up to 1? Does it add up to 1? No. How much is this adding up to? 0.75. What do you think is happening with the remaining 0.25? That is the unrealized gain. What's happening is, in most countries, you pay a capital gain tax on realized capital gain. When they say capital gains over here of 3600, they are referring actually to realized gain. So the value went up, or this is how much he had at the end of the year, but 75% was realized through either interest or dividend or actual realized gain. The remaining 0.25 was unrealized gain. We'll get to this in a short while. If you look in the curriculum straight after example 6, you will see this concept of an annual return after realized taxes. What do you think this means? How much is our return? Like, you might have an example that says that the total before tax return is 8%. But then there is also a return that you are getting after your realized taxes, and the expression for that is R star. If R is 8%, that 8% meant before any realized taxes. This R asterisk is your return after realized taxes. This is given by, what does the regular R mean? Before any taxes, multiplied by 1 minus PI times TI. What are we subtracting here? This is the tax that you pay on your interest income, because PI was your interest income and T multiplied by that is your, so this collectively is the tax that you pay on interest income. Then you need to subtract the tax that you pay on your dividend, and then you subtract the tax that you are paying on realized capital gain. So PCG multiplied by, this expression is giving you your annual return after realized taxes. Notice that we haven't taken into account the fact that we have unrealized gains, and at some point we'll have to pay taxes on those unrealized gains. That we'll get to in a short while, but I hope this makes sense. If it does, let's do example 7. Portfolio is 100,000, grows to this much by the end of the year. We are given these numbers. We are also told that the realized capital gains are taxed at 15% and interest is taxed at 35%. So the TD and T capital gains both equal 15%. What is the annual return after realized taxes? We are trying to calculate this number over here. So for part 1, we are calculating R star. What's R? That's the 8%. So let's put in 0.08 multiplied by 1 minus, what is this over here? So this was 0.05 multiplied by 0.35, which is the rate for interest, and then we subtract what was the portion of the dividend? 0.25 multiplied by 0.15, and then what do we subtract after that? Multiplied by 0.15. If you do the math, what we are going to get is 7.02%, or if you are working in decimals, you'll get 0.0702. What is this number? It is the annual return after realized taxes. What is the balance at the end of the year after taxes are paid? How will we do this? What I want you to do for this is pause this video over here and you look at the table that is given. In fact, first try to solve this on your own, and then you look at the table that is given, and you will notice that the total tax that is due is 980. And effectively what you have at the end after paying taxes is 107,020. Fairly straightforward calculations, but you must go through them because these straightforward calculations don't look so straightforward when you get them on your exam. Future long-term accumulation. In the previous example, we did not consider deferred capital gains taxes. If we do, then what we get is called the effective capital gains tax rate, and that is given by this expression, which is perhaps one of the hardest so far, this and the following one, and these, I think the best thing to do is memorize it. There is a footnote that says that you can look at so-and-so paper to get a detailed explanation. I doubt anybody will go look for that, but here is what you need to memorize. T star, this is the effective capital gains tax rate. This is equal to TCG. What do you think this means? And what was this in our example? This was the 15%. Multiplied by 1 minus your portion of interest minus portion of dividend minus portion of capital gain, and then all this divided by 1 minus portion of interest times TI minus portion of dividend times TD minus portion of capital gain times T capital gains. The way you can think of this is, what is the denominator here? This is how much money you have left after paying all your taxes, and you can have whatever interpretation you want of the numerator. I find this a little hard to understand and explain. I think the best thing to do with this is memorize it. Even the curriculum doesn't try to give too much intuition behind this expression. This then becomes the first expression through all the expressions that we've seen so far, where you just effectively memorize. All the other expressions, there was some logic that I could communicate. Then future after-tax accumulation. This one you need to memorize, but it will be a lot like what you've seen before. So this is the future value. Future value interest factor given this effective tax rate. This is equal to 1 plus R star. What's the R star? This is the effective realized return or gain. We have this to the power of n, and then you multiply by 1 minus T star, which is your effective tax rate, effective capital gains tax rate from here, and then you add the T star, and then you minus 1 minus book value times TCG. Does this look like something you've seen before? This was one of the, if you look in the curriculum, you can compare this with equation 3. This is the equation that you saw with the capital gains example. The only thing we've done is replace the R with R star and the T with T star. And then what's the B? This is the cost basis. All this will look really tedious, and it is. You essentially have to do all the examples and then do the questions at the back. We are nearly at the end of section 3. Let's now look at example 8. You need to solve this now. Example 8 talks about future long-term accumulation. You have a portfolio of 100,000, 8% gain, 5-year horizon. You are given the interest, dividend, and capital gain. The same tax rates apply. 15% for realized for dividend and realized capital gains, and 35% for interest. You can use Exhibit 5 in the curriculum to solve this problem, but I want you to spend a few minutes here to actually try and get the numbers that they have shown in this example. What I want you to make sure on this example is that the numbers which are given for R star and T star, you can calculate these using the formulas that we've just talked about. R star is the annual after-tax return, and T star is the effective capital gains tax rate. Make sure that you can actually get these answers. It's very straightforward. The question is, what is this whole idea behind future long-term accumulation? The idea is that in the long term, when you are paying all 4 kinds of taxes, in this example, the 4 taxes are: you are paying taxes on interest, you are paying taxes on dividends, you are paying taxes on realized capital gains, and in the long run, you are also going to pay taxes on the unrealized gains. At some point, they'll be realized. The point is, when you pay all those 4 kinds of taxes, what is your accumulation after these 4 kinds of taxes? Now, that's what these numbers are telling us. What was the R star? This was the return without any taxes on unrealized gains. Then to get your actual return in the long run, you also need to subtract your estimate of the taxes on unrealized gains. Even though you are not paying taxes on unrealized gains in the first year, but effectively in the long run you will be paying a 4.27%. Both these numbers have to be taken into account to figure out how much wealth you will have in the long run. Section 3.3, accrual equivalent returns and tax rates. Here there is just one example we'll be doing, but the concept is extremely important. Accrual equivalent after-tax return is the tax-free return that, if accrued annually, produces the same after-tax accumulation as the taxable portfolio. I'll give you a very simple example because you need to understand this well. Let's say you invest 100 and then this number goes from 100 to 130, but you pay taxes equal to 9. What are you left with after taxes? 121. All this happens over 2 years. Isn't this exactly the same as investing in a tax-free environment at 10%? You might recall an example from level 1 fixed income where you compared two bonds, one a municipal bond without any taxes versus a tax-bearing bond. This is that same concept. What we are saying here is a 10% return without taxes. So effectively we are saying, okay, after all taxes, we effectively have a 10% return. This 10% is your accrual equivalent return. It's the return that you would get. I think this is the best definition actually. Now this definition will make more sense. Accrual equivalent after-tax return is the tax-free return that, if accrued annually, produces the same after-tax accumulation as the taxable portfolio. Once you see this example, this definition makes total sense. The example that is embedded in the curriculum is as follows. You start with 100 and you end up with 138.66 in 5 years after taxes. What is the accrual equivalent return? The way you can do that is you can say 100 plus or 100 multiplied by 1 plus RAE. What's RAE? That's your accrual equivalent return to the power of 5. Where's this 5 coming from? 5 years. This will give you 138.66. You simply solve for RE, that is your accrual equivalent return. And then what is the accrual equivalent tax rate? In our example, you can look at it this way. This should look a lot like what you saw at level 1 fixed income. If this is your regular return, mine into 1 minus your TAE. What's TAE? This is the accrual equivalent tax return, gives you the RAE. So this is your accrual equivalent tax rate. I'll read from the curriculum. This accrual equivalent tax rate is the hypothetical tax rate that produces an after-tax return equivalent to the accrual equivalent return. I think the better way of just looking at it is this expression, and then what you need to do is work through example 9. It's a very straightforward calculation. I'm sure you can do it, so you just pause this video here, do example 9, and then you will be on top of this concept of accrual equivalent return. We'll continue now with section 4, types of investment accounts. Simplistically, there are 3 kinds of investment accounts that you need to be worried about, or these are actually 3 categories. The first, and one that we've been mostly talking about so far, this first category is taxable accounts. In a taxable account, the money that you put in is after tax. And just to make sure you are very clear about what this means, when you earn, say, $100 a month, you pay 30% tax on it, you are left with $70. It is this $70 that you are investing. So this is a after-tax investment, and then the return that you get is also taxed. The return might be either taxed every year or taxed at the end of your investment horizon, but the point is that money going in is after tax and the return is also taxed. That is the most basic form that we have talked about so far. Another category is tax deferred accounts or TDAs. The classic example in the United States is a IRA, individual retirement account. The way you can think of this is as follows. Let's say this is an individual retirement account. The money that goes in is before tax. In other words, you earn the $100. You can put this $100 into your IRA without paying any taxes. The entire $100 goes here, but when you take money out of your retirement account, when you retire at say the age of 62, then you need to pay a tax. And this is a big tax because you have not ever paid any tax before on this money. How big is that tax? That I will show you in a minute. But let's also first understand the third category, which is tax exempt accounts. What happens with tax exempt accounts is that the money that you put in is after tax. In other words, going with the simple example that I've talked about so far, you earn $100, you pay taxes worth $30, and you are left with $70. It is this $70 that you put in, but then the money that you take out has no taxes on it. In the United States, this is called a Roth IRA. Many people in the US have an option between IRAs and Roth IRAs, and in a subsequent section we'll look at how we decide between these two. But at a basic level, you need to understand these three categories. Let us understand the calculation by looking at example 10. If you are going to invest 100,000 for 20 years, imagine you have a 7% return and a 20% tax rate. What will your wealth be after 20 years if you put your money in a taxable account which is taxed annually? This is what we studied in section 3. What was the future value factor over here? Your 100,000 will become what? 100,000 multiplied by? We are being taxed every year, so you do the plus 0.07 and then multiplied by 1 minus the tax rate. 1 minus 0.2, this is multiplied by the, essentially what you are left with is 0.7 into 0.8 raised to the power of 20, and this will give you how much? 297,357. The next then is you have a taxable account but a deferred capital gain tax. This is just a refresher. What will we have here? 100,000 multiplied by 1.07 to the power of 20. Then this entire amount is multiplied by 1 minus 0.2, and then you add the tax. Here I'm using that formula which we derived after some algebra, where we added the tax rate at the end. This is not as intuitive as the earlier formula that we came up with, but this is shorter and easier to remember. Now we move to the material we just studied, which is a tax deferred account. This is also called a TDA. This acronym is used quite often. The future value factor for a TDA, I'll just help you remember this first. The future value interest factor for a tax deferred account is equal to 1 plus r to the power of n multiplied by 1 minus the tax rate, the tax that you pay at the end when you withdraw the money. Notice that this number, if you invest $1, was that $1 that you invested, was this $1 after you paid taxes or before you paid taxes? The $1 that you put into a tax deferred account, this $1 was before you paid any income taxes or any taxes of any sort. So this $1 is going in that has never been taxed. Unlike all other examples that we talked about in section 3, where the money that you put into your investment account was money that you had paid taxes on. Here you've not paid taxes on this. That is why when this 1 becomes 1 plus r to the power of n, where it's grown at a rate of r after n years, then what do we have at the end? We have 1 plus r to the power of n, and this whole thing then is multiplied by 1 minus t. So this is our future value interest factor. In our example, what do we plug in? This factor is multiplied by 100,000 because that's the amount. And then 100,000 multiplied by what's r? 7. So you have 1.07 to the power of 20 years. And then you multiply this by 1 minus 0.2, which is 0.8. And what do you get? You get 309,575. And then what about part 4, tax exempt account? What is this? You put money in that has already been taxed, and then when you take money out, then you don't have to pay taxes. Let's say that you put in $100,000. What will you get at the end? 1.07 to the power of 20, which is 386,968. Can you compare these two numbers and say tax exempt is much better? What do you think? Not quite. Why? Because let me just give you a simple example. Let's say that you are in a country where your income tax rate is 33%. This $100,000 is money that you put in without having paid any taxes. This 100,000 you got after paying taxes. You would have to have 150,000 on which you paid taxes end up with this, and then this number grows. In this example, you got 386,968 starting with 150, paying your 33% tax, getting here, and then this grew. With a TDA, you put in this money without ever paying any taxes upfront. Therefore, you can't just compare 309 with 368 and say this is better. Very important point. Section 4.3, after tax asset allocation. There are no examples here. I think there is just a basic point that needs to be understood from this whole subsection. Let us say your client has stocks worth 1.5 million in a tax deferred account and bonds worth 0.5 million in a tax exempt account. I just created this acronym. The acronym TEA is not used very often. Whenever I have seen this written in the curriculum, it always says tax exempt, but TDA is used quite often. What are the weights of stocks and bonds? It might seem that the weight of stock is 75% and the weight of bond is 25%, but there is something wrong with that, because what we really need to consider is the after-tax weights. Notice in Exhibit 6 that the bonds are in a tax exempt account. That means that this 0.5 million is actually an after tax amount because you have already paid taxes. On the bonds, you will not be paying any taxes anymore. If the bond appreciates, the bond doubles, will you be paying taxes on the gain? You will not, because you already paid the taxes to come up with the 0.5 million to put in here. What about the stocks? Can the same thing be said about stocks? If the stocks double, will you be paying taxes? You will be paying taxes. Therefore, simply saying 75%, 25% is not right. Bonds 0.5 million is okay. What you also need to then take is the after-tax number for stocks. And when you take the after-tax number given the rates, and I don't think we need to get into the mechanics or the calculation, the after-tax number for stocks is really 900,000. Therefore, the weights of stocks and bonds should be based on 0.9 million and 0.5 million, which then becomes 64.3 for stocks and 35.7. The fundamental point for this whole little subsection is that what really matters is the after-tax weights. Section 4.4, choosing among account types. Let's say that you need to make a choice, and many years ago I had to make this choice. When I was investing for retirement, I could either put my money in an IRA or in a Roth IRA. Obviously, to make this choice, you need to try and figure out that when you retire and you take out money, after taxes, where are you better off? Is it obvious which one is better? It is not obvious. You need to do some calculation, but what are the two main points to consider? The first main point is that your contribution to a IRA is tax deductible. What this tax deductible means effectively is that if you own 100, if you earn 100, you don't need to pay any taxes. That entire 100 goes in here. Versus with a Roth IRA, if you earn 100 and you are paying a 30% tax, how much money will you put into your Roth IRA account? You would only put in 70. This calculation needs to be done. What else must you consider? You must also consider that when you retire, let's say at the age of 60, and you take money out, what do you expect your tax rate to be when you retire? In my example, when I did this, I expected my tax rate at retirement to be much lower than my tax rate over here. So what made more sense for me? It made more sense. Here I was in a high tax bracket when I was putting my money in. So I put my money in to a IRA because that prevented me from paying high tax over here, knowing that 30 years later I would probably be in a low tax bracket. So for me, this made sense. For somebody else, if they are in a relatively low tax bracket here, but they expect to become very rich and have lots of income later on when they withdraw, then a Roth IRA might make more sense. But the calculation is fairly straightforward. Ultimately, you decide what's better by doing the calculation. And this example 11 actually illustrates the calculation. You need to figure out how much you put in and eventually how much do you make on a after-tax basis. Spend a couple of minutes on example 11 and just look through the numbers. Make sure you can understand what they're doing and you can do this calculation. Section 5 is taxes and investment risk. This is about 1.5 pages, and I think what I have given on this slide is the core point from this section. For assets in taxable accounts, now going back to what you studied in section 3, you put your money in a taxable account, so you're putting in your after-tax money. The income or the growth that you are getting is being taxed. Now, what happens to investment risk because of taxes? Without going through all the justification and the logic, the key point is that the taxing authority, which is typically the government, shares the investment risk with the investor. The point is that if an investor makes a huge return, does the government benefit? It does, because when you make a big return, then obviously the government is going to get X% of a higher return, so there is a benefit. When you make a low return, if there is a loss, does the government lose out? The government loses out. Therefore, simplistically, you can see that the tax authority shares both the risk and the return with the investor. Hence, again, simplistically, taxes can reduce investment risk. If your overall risk on investment is denoted by sigma, the variation, then it can be shown that given taxes, the risk is reduced to sigma into 1 minus the tax rate. On a taxable investment, the standard deviation becomes sigma into 1 minus t. We don't need to know the derivation. If you want to be really diligent about looking at some numbers, you can look at Exhibit 7, but I think as long as you know these points, you are in good shape. The final point on this section is that for tax-deferred assets and tax-exempt assets or accounts, actually this is tax-deferred accounts and tax-exempt accounts, there the investor bears all the risk associated with the returns. Just remember these 2 points. Section 6, which is the final section in this reading, implications for wealth management. As a financial advisor, one of the things that you need to do is effectively manage the tax liability or the tax obligation. You need to work with your client, make sure the money is put in the right kinds of accounts, and when you make your investment choices, you need to consider tax implications. The strategies or techniques that you use to legally manage or minimize the tax obligation is called tax alpha. In this section, we have these 5 subsections, and effectively you need to know a little bit about each of these subsections. The first one is tax or asset location. I talked about this briefly in an earlier lecture in behavioral finance, and at that point I said we will cover this later. Now is the later. As we've already discussed, there are 3 types of accounts: taxable accounts, tax-deferred accounts, and tax-exempt accounts. These are 3 different buckets or categories. Which bucket you choose to put a given investment in is called your asset location decision. What are the sorts of factors that you will think of when you decide which bucket to put your investment in? And what I've done here is tried to identify the core point, which I think is what you need to remember. If you want to know all the details, they are in the curriculum. But let's look at your retirement planning. On the left, I have combined the tax-deferred accounts and tax-exempt accounts. Let's say this is one bucket, and the other bucket is your regular taxable account. So you have some assets. You want to decide what to put away in this bucket, essentially for retirement, and what assets to keep with you because you might need to liquidate those assets or get the income from these assets. Securities which would otherwise be heavily taxed should ideally be put here. In other words, you are deferring the tax, and lightly taxed securities might be put in your taxable account. I think this is the main point from this section. The curriculum talks about maybe there are restrictions on how much you can put in here, in which case you can use some shorting strategy and so on. But I feel that if you know this point that I just made, that's fundamentally the most important point to know in section 6.1. Next is trading behavior. And here again, I have pulled out the main point from here. I hope you know that very often the tax on short-term gains are higher than tax on long-term gains. When you buy and sell a stock within a year, the capital gain tax is higher than if you sell the stock after longer than 1 year. What does this say about short-term trading? This should reduce short-term trading. So the implication of your tax structure is that this should reduce short-term trading. And I think the most useful sentences given in this section is that active managers must earn greater pre-tax alphas than passive managers to offset the tax drag of active trading. What's this tax drag of active trading? Active trading means that you are paying higher taxes because short-term capital gains are taxed at a higher rate. So that extra taxes is referred to as the tax drag. Tax loss harvesting, section 6.3, and this is quite important because there are 3 examples over here, example 12, 13 and 14, and I have this heuristic that the importance of a section is directly proportional to the number of examples that you see. The first point here is to understand what do we mean by tax loss harvesting. The concept is fairly straightforward, that in a given year, let's say that you have a realized gain of 60,000. Are you going to pay taxes on this? Yes, you are. Let's say that there is a 50% tax rate. That means you would be paying 30,000 taxes. You happen to have some securities where you have incurred a loss of 40,000. If you sell those securities in order to counter this gain and to reduce your tax liability, your tax obligation, that is called tax loss harvesting. Example 12, which is very simple, illustrates this idea. You can spend a couple of minutes and actually just look at that example. The calculations are really straightforward. Let us now look at a few points that you need to know, because I think from an exam perspective these points are important. The tax savings realized in a given year from tax loss harvesting help you, or they result in overstating the true gain. Because of your tax loss harvesting, that reduces your taxes, and hence you overstate the gain. But is this a free lunch? What do you lose when you do tax loss harvesting? The idea is this: selling securities at a loss resets the cost basis. Earlier, if you had purchased your securities for 100 and now they are down to 60, what happens with tax loss harvesting? You actually then sell your securities for 60. This helps you cut your taxes, but then your B now becomes 60, because you then, when you are doing tax loss harvesting, then you are rebuying that security at a lower base. If you are buying at a lower base and later on the stock goes back even to say 100, are you going to pay this tax later? You are. Therefore, tax loss harvesting is not a free lunch. You have just delayed your tax obligation. Is this bad? Not necessarily. The curriculum doesn't explicitly say this, but given time value of money, paying $1 today is better, or paying $1 tomorrow is better. When you are paying, then paying the same amount of money later is better.
This is legal.
This is absolutely legal.
You have to buy at the rate.
The question is, do you have to buy that? You don't have to buy at the lower rate, but if you are purely selling to execute this tax loss harvesting strategy, but you really do want the stock, then you would sell it and then buy it. What you can now do is example 13, and then here is another bullet point. Recognizing already incurred loss for tax purposes increases after tax money available for investments. What does this mean? That when you recognize the loss, that reduces your tax bill, so you have more money to spend or to buy more stocks. The point here is with tax loss harvesting, you need to know what it is. You need to know these bullet points because any of these bullet points might show up on the exam. And you need to do examples 12, 13 and 14, all of which are numerically fairly straightforward. And the last point in this section is a strategy that is very similar or related to tax loss harvesting, which is a strategy called HIFO, or highest in, first out. And again, this is something I've done. I bought mutual fund shares over a long period of time. Let us say that between 2000 and 2009, I bought mutual fund shares, where initially I bought it at $2 per share, and eventually I bought units at $20. And then let's say that in 2011, I wanted to sell. And I was in a high tax bracket over here, for example. Which one should I sell, this one or this one? I should sell 2009 because let's say the price here is 24. Then my tax is only on this differential of 4. Later on, I expect to be in a lower tax bracket. At that point, I can then sell earlier. This sounds a lot like what that you did in level 1 FRA. This sounds a lot like LIFO, even sounds like LIFO. It simply means that highest in, first out. Exactly, that's a good point. This makes sense if prices are increasing. Had prices been decreasing, then I would have done, essentially the point here is not really last in, first out, it's really highest in, first out. In times of increasing prices, it would be like LIFO. Holding period management, straightforward point. Many tax regimes encourage long-term investments. We've already seen that to some extent. What should that mean to an investment advisor? It should simply mean that you need to know what the taxes are for different holding periods. Take that into account when you decide what to sell, when to sell. Do example 15 for that. And the final point is in section 6.5. After tax mean variance optimization. If you recall, in level 1 and to some extent in level 2, when we did mean variance optimization, we generally ignored taxes. But is that the right thing to do? That is not the right thing to do. We should actually look at the after tax risk and return when we do our mean variance optimization. What is the appropriate tax rate to use? We should look at the accrual equivalent returns. Do you remember what these are? These are our returns after taking into account taxes. So those are the returns we should use. What are the risk factors or the sigmas that we should use? It should be the sigma into 1 minus t. All our calculations should be after tax. And another dimension of mean variance optimization is to also consider the optimal asset location. We never saw this before, and fortunately for us, we don't need to get into the details here either. Just we need to recognize two main points. That in our mean variance optimization, we should consider the impact of taxes, both on risk and return, and we should also consider the appropriate location of our assets. That brings us to the end of this reading. It is a tough reading in the sense that you have a lot of formulas, but if you do the examples religiously and then you work through the 22 questions at the back, you will be in good shape.